This is a story about two economies in transition. In the United States, as President Trump shakes the foundations through tariffs,
foreign nations will finally be asked to pay for the privilege of access to our market, the biggest market in the world. We're right now the biggest market in the world. We had a great country 4 years ago in terms of the economics. We were doubling up on China. We were doing so well, nobody was going to catch us.
And in Europe, suddenly facing the need for massive defense spending it never really expected.
The era of the peace dividend is long gone. The security architecture that we relied on can no longer be taken for granted. The age of spheres of influence and power competition is well and truly back.
While the new administration in the U.S. slashes regulations and the size of the government to keep the country competitive, the EU is dealing with a stalling economy that is falling behind its Western peers.
The U.S. has something really important, which is what I call a growth mindset. So whatever government is in place, it has always been more pro-growth.
Before President Trump announced sweeping tariffs, we spoke to Anna Botín, executive chair of the Santander Group. It's the 14th largest banking institution in the world, with operations in Europe and the Americas North and South. 38% of its net revenue comes from Europe, and South America comes in second, contributing 32%.
You can see that in the growth of the last decade than Europe. So it's early, but I believe that that is a very positive sign. And as I like to say, Europe is awakening, and the alarm clock has been President Trump. Because what I have never seen is the president of the Commission saying that we're in extraordinary times and we need to take extraordinary measures. So it's not just good for the US, it's good for Europe. What's happening is good for growth, it's good for citizens and society, because I believe that is, there are other factors that are not as positive, but this is a very positive signal that businesses will be able to do more, invest more, and create more growth.
Are we seeing action yet? And how much of it is being triggered, frankly, by what's going on in Ukraine and European countries deciding they really have to step up and spend more on defense?
It's a combination. I think geopolitics and what's going on in Ukraine, but also the economic let's say, policies of the U.S. administration. So I think both of those are drivers for what I see as, the German awakening, the lifting of the brakes on debt. Germany lifting the brakes on debt. It's harder except when Europe is in a crisis. And the feeling now in Europe is we are in a crisis, or we could get into a crisis unless we do something fast. And so there is a sense of urgency I have not seen before. And this is good also for companies and banks. We do business in Europe. One of our biggest markets is Spain. Spain is going to grow at close to 2.5%, even 3%, depends on who you ask. So yes, I think what's going on is both structural, but also due to the pressure that we're feeling on both the war and the economy.
It wasn't always a positive picture for Spain. During the European debt crisis of the late 2000s, Spain was among the 5 EU member states that were struggling to repay their debt. Now, its economic growth outpaces Germany, France, and the United Kingdom. Part of the problem is a European-wide monetary policy coupled with fiscal policy run by the member states, often in different directions. What about capital markets in Europe? Because it's been thought that part of the driver of growth in the United States has been the robust capital markets. So people will raise capital to invest in, for example, startups and tech companies. Can Europe move in that direction to have more robust capital markets?
This is one of the big goals we've had for years. Again, what's happened, the awakening that I can see in Europe, led by Germany and possibly France, means that Germany will invest 1 trillion euros, $1 trillion over the next decade in defense. And the way they're going to finance that is through a common Eurobond. So that effectively is one of the potential drivers for this common capital markets union, which we call it in Europe, which again is good for banks.
What is the role of regulation in all of this? When it comes to the United States, you famously asked President Trump about deregulation at Davos earlier this year. What are the regulations that can help or hinder what you want to do at Santander?
So regulations matter. That's why I asked the question. I've been very vocal about this. It's about regulation, but it's also about supervision, how the agencies interpret the regulation. And this is one of the quick wins. That's why I asked the question. So I see governments as enablers for business. Businesses create wealth, create companies and jobs. That's where, we pay taxes, government can deliver other services. So just by getting the balance right on regulation, and at the end, regulation is there to protect consumers, but if you overprotect them, you don't grow.
The European Commission turned to former ECB President Mario Draghi to study the effects of the single market on competitiveness in the EU. In the report published in September 2024, Draghi says regulation should be designed to facilitate market entry, not become a barrier to Europe's goals.
A little over a decade ago, the US and European GDPs were they weren't exactly on top of each other, but they were pretty close, 16 versus 15, roughly. And now the European GDP is 15 or 16 trillion, I think, and the US GDP is about 30 trillion over the course of a little more than a decade. And that is a function, that's a function of a lot of things, but it's a function of a lack of investment in productivity and an over-regulation of the European economy. And just as I think that we could have a significant effect on American growth by streamlining our regulation, I think you could have an even more dramatic effect on European growth if they were willing to undertake that deregulatory project, some of which has been suggested recently by Mario Draghi in his report delivered to the European Commission.
During his tenure as vice chair of the Federal Reserve, Randal Quarles dealt with policy recommendations for regulating financial institutions. He agrees with Draghi's concerns that regulations have played a part in holding Europe back.
They really haven't created a European-wide financial regulatory system, and that fragmentation contributes to a great deal of cost where there are not conceptually dramatic, but material and important differences from one jurisdiction to another within Europe with respect to financial regulation that continue to increase cost. And so from my point of view, the most important thing that Europe could do would be to accelerate and advance its Europe-wide framework for financial regulation, even more than some of the important particular changes that they could make. If Europe could refine its regulation of capital provision, the venture capital ecosystem in Europe, for example, is very underdeveloped, and the provision of financing, really of any sort, to startup companies is not terribly robust, certainly compared to America. The reason that we have such an advanced tech sector is that for decades, we have had, nurtured, tried to develop a capital financing system that supports the provision of capital to these risky startup enterprises, and Europe has not done that. Were they to make changes to the governance of capital provision that supported particularly that sort of financing, I think you could, in a relatively short period of time, call it a decade, make a big dent in that. When you consider how much the technological landscape has changed in the United States, how different the technologies that are being deployed now in the US are from what they were 10 or 15 years ago, all of which supported by our financing system. If Europe had had a financing system that was as well geared as ours to supporting that kind of innovation, they would have participated in that to a much greater degree than they have.
Unifying capital markets is not a new concept to Europe, but the idea has never really gotten off the ground, and Quarles thinks that the Trump effect might be what Europe needs to start moving towards making the changes it needs.
I think it's true nonetheless that Europe has had a wake-up call. And it's been very unpleasant, but I have talked to a number of European policymakers over the course of the last month. It really hasn't been much more than a month. It seems like it's been much longer than that. It certainly seems like that to the Europeans. And there is a intensity and practicality to what they are now saying they would be prepared to do in the way of accelerating regulatory change, accelerating investment in defense that really never was there before. And again, while it has been unpleasant medicine, I think it could have a very good result for Europe.
In a global economy, the race to grow is not a solo sport.
Economics and economic growth is not a zero-sum game. When you have a vibrant Europe, that is, that's better for us. There are many, many win-win opportunities when you have two dynamic economies that are interacting, competing, partnering with each other. And we would be much better off if Europe were economically healthier than it is currently.
And Anna Botín believes that opportunity for growth and scale and diversification is the path forward for Santander as well.
Going back to the key competitive advantages of Santander, global and in-market scale, 173 million customers, one of the largest consumer bases in the world. The second key strength is diversification. We do better when things get difficult because we have geographies and businesses that tend to compensate each other. Now, having said that, we obviously factor geopolitical risk into our risk analysis. And this is where being a bank that has been around for 168 years helps, right? So we've gone through many crises. We've gone through the Industrial Revolution. We're going through another change in an era right now with AI. And so we factor that into our processes. And that's one of the things that we do, I believe, better than others.